Our Region's Business is sponsored by PNC for the achiever in you. Our Region's Business. Innovation, transformation, momentum. Improving our communities and driving technologies that will shape our region for generations. The collaboration that brings vitality, prosperity, and life to living. Stay with us for the coming half hour as we examine in depth our region's business. Now, here's your host, Bill Flanagan.
Today on Our Region's Business, so looking for a last-minute holiday gift idea? Well, a pair of startups based right here in our region have come up with one of the hottest tech toys this holiday season. Plus, we'll meet another local startup that's making life more secure. But first, holiday retail sales, the Eurozone, and the economic year to come. Stuart Hoffman is here to help make sense of it all. He's Chief Economist of the PNC Financial Services Group, a sponsor of Our Region's Business. And welcome back. Good to see you.
Thank you, Bill. Can't count the number of years we've been doing this.
I know, better part of 30, I'm sure. Although I suspect this year we could probably just rerun the tape from last year. We would be covered looking ahead.
I'm not sure I ever want to rerun any tapes of what I said a year ago, but I'll do a self-report card. A year ago, we thought 2011 would be a year of continued modest recovery. There were a lot of shaky times during the year. Last fall, concerned maybe the economy was falling back into recession and jobs barely grew. But actually, we're ending this year on a bit of an up note. Stock market's been about flat. If you ignore the minute-to-minute, day-to-day, weekly giant gyrations, but year-to-date it's about flat. And this region has actually moved ahead and done fairly well over the course of 2011. So that's looking backward. And then, as you said, I'm not sure we can exactly replay it, but maybe some similar themes for 2012. Okay,
so again, kind of this very modest recovery for the nations. You're not necessarily looking then for another dip into a recession next year.
Definitely not. If anything, you know, those so-called double dippers, the chicken littles who always like to make bad news have been wrong so many times I've lost count. We're not talking about our strong economy in this presidential election year coming up, but we think the economy will grow around 2.5% by GDP terms, which is a bit better than it looks like in 2011. We think we'll add nationwide about 1.5 million to 1.75 million jobs, all in the private sector. That means the unemployment rate should maybe end the year just south of 8.5%. And we think the stock market, after sort of treading water all this year, will be on the upswing for some moderate gains in 2012.
Okay, well that sounds pretty good, but then you look across the pond at what's going on in Europe. Doesn't that concern you at all?
Oh, there are a lot of things that concern me, and certainly what's going on in Europe, or could be going on. Europe is headed into recession, at least Western Europe is definitely in a recession. Certainly the southern part of Europe, Italy, Greece, probably already in a fairly steep one, but even France, Germany, and the UK, while not part of the European Monetary Union, are probably in recession as well. So we do expect that Europe economy will decline next year by maybe 1 or 2%. We don't think that'll be mirrored in the Far East. We think China will continue to grow. We think there'll be growth in Latin America. We think our North American neighbors will show some growth. So there's no question I'm concerned by what happens in Europe, but U.S. exports to Europe account for 2% of our economy.
Wow.
So if they fall 10%, and that would be a pretty severe decline, it would knock growth down by about 1/4%. It's not the difference. It's not make or break. And we've tried to factor that in some of my earlier comments, that growth will be moderate, already assuming that Europe will have some drag on the U.S. economy, but not enough to drag it down into recession with Europe.
Okay, taking a look, I'm sure, at the holiday sales picture and everything right now. It seems to be shaking out pretty well by some of the accounts I've seen.
Yeah, when I put out my forecast in early November, I was above the National Retailers Association, a little more optimistic, talking about a 4% gain. Black Friday was a strong start to the weekend. It lulled off. I think in the remaining couple of weeks, not only into Christmas, but in the post-Christmas rush, we'll end up with sales up about 4% from a year ago. Not as strong as the gain last year, but about half of that's inflation because apparel and other items, gold, jewelry, cost more than a year ago, but 2% in real terms. So the consumer's engaged. They're still cautious, but consumers are not down for the count. The person you see when you wake up in the mirror in the morning, us. We are the great American consumer, and while we're nervous, it still seems to me as though we're going to do some spending for the holidays and help drive a decent Christmas for retailers in the country.
But that means when you look at inflationary pressures and interest rates, still very soft upward pressure in that.
Very little. No, hardly any upward pressure on interest rates. Interest rates, they came down some rates this past year. Chairman Bernanke and the Fed have all but guaranteed they're not going to raise, or they can't lower rates because they're already near zero over the course of 2012. So whereas last year the bond market was a good place to be, this year we think it's going to be sort of neutral. You won't see the drop in rates would propel bond prices up, and obviously the yields you get are not very high. So that's why I said earlier, we actually think the stock market will outperform the bond market as an investment return in 2012. Just the opposite happened in 2011.
Fascinating. Well, let's get local for the last minute or so we have. We've been outperforming the national average now for a few years running. How's it look for 2012?
As we said, you and I can both remember when the Pittsburgh area economy looked very, very different. Since the early 2000s, this leopard really has changed its spots. And we have seen during the worst of the recession of 2008, 2009, Pittsburgh certainly didn't avoid a recession, but it was milder, no housing boom, bust, no subprime. And growth the last 2 years, 2009 and 2010, has occurred in Pittsburgh. In fact, last year we created about 11,000 jobs locally on par with the national economy. Our unemployment rate is just about 7% compared to an unemployment rate nationwide that's closer to 8.75%. We think over the course of 2012, the housing market will be stable, maybe a little better. Home prices in Pittsburgh will probably go up a little. And we think we'll create about another 10,000 jobs in the coming year. That's about 1%. And that should bring the unemployment rate down a little under 7%. So hopefully a year from now, when I'm sitting here giving my report card on what I said last year for 2012, we'll be looking at a local unemployment rate below 7% and jobs in the southwestern Pennsylvania 10,000 or more higher than this time this year.
All right. Well, that's something to look forward to. You know, we're not quite as a dismal economic report as we've had to deal with a few years ago. Anyway, Stuart Hoffman from PNC. Thanks so much. Really appreciate it.
Thank you, Bill.
And next up, 2 Pittsburgh startups create one of the hottest tech toys this holiday season. Stay with us.